Thanks, Renee, and thank you to all of you for joining us today. As we get started, I want to say that we certainly welcome any comments any of you may have on today's presentation, and we are also interested in hearing from you about any suggestions or specific topics that you would like us to consider for future webcasts. For your reference, our contact information is provided at the end of this presentation. It is worth noting that the source of all the data presented today is from the AFS Pricing Dashboard. This database is the industry source of pricing trends for commercial lending and contains over $1 trillion in commitments, with approximately 80,000 new and renewed loans being added to our database each quarter. In addition, the AFS Pricing Dashboard is also used to prepare our monthly Pricing Trends newsletter. If you are interested in receiving our newsletter, you can reach out to me and we will be glad to add you to our mailing list. And if anyone is interested in learning more about our pricing dashboard, again, you can reach out to us. Our contact information is provided at the end of this presentation. As we do in each of our webcasts, we will look at commercial lending with a focus on balance growth, new and renewed volume, and pricing for spreads and fees. For our special topic today, Jeremy Charlson will analyze the loan growth and pricing trends for the finance and insurance industry. This sector is a large and growing exposure for many of the banks we work with, and as Jeremy will show, finance and insurance was a big driver of the rebound in C&I loan growth at the end of 2018. Before we dive into the numbers, in our last webcast, we were commenting that it is true that lending tends to slow down during the summer months of the third quarter, and some corporate customers could still be flush with cash as a result of the tax cut. There were analysts wondering if a company's reluctance to borrow is a sign that an economic downturn was on the horizon. There were also comments that customers were refinancing their debt with non-bank competitors, such as private equity firms. With the fourth quarter results, it looks like C&I lending is showing signs of a comeback. Commercial loan demand picked up early in the fourth quarter and really accelerated in the month of December. However, there are some issues that may discourage companies from borrowing in 2019, like the ongoing trade war between the U.S. and China, rising interest rates, and intense competition from non-bank lenders, especially involving commercial real estate. So what's next? Following up on a strong fourth quarter, in our next webcast, we will look into how this all plays out during the first quarter. Let's move to slide 6, where we provide a quick, high-level overview of the commercial lending market. Starting at the top left, a quarterly trend of total balance growth is presented. We can see the pace of balance growth for the fourth quarter at 2.18% was much higher than the 0.8% rate we saw for 3Q18. We commented in our last webcast that the 3Q18 rate was significantly higher than the 3Q17 and 3Q16 rates. And we can say the same for 4Q. That is, the 4Q18 rate is significantly higher than 4Q17 and 4Q16. The top right chart shows that there was a year-over-year increase for both new and renewed loans. The bottom left chart shows a trend of the weighted average LIBOR equivalent spreads for new loans and renewals. As we just saw, both new and renewed loan volume was up year over year, and the related LIBOR equivalent spreads were up slightly when compared to December 2017. New loans increased 5 basis points, and renewals were up 3 basis points. And finally, on the bottom right chart, we see that total fees as of December were very similar to last year's fee levels, with a modest increase seen in upfront fees. With this quick overview as a backdrop, we will now examine how these pricing dynamics are playing out differently across the various lending segments. On the next slide, we take a closer look at the types of loans driving the trend in overall balance growth. The top chart on this slide compares quarter-over-quarter growth rates between bilateral loans and participations. For those of you that were on our last webcast or receive our monthly newsletter, you may recall that at the end of the third quarter, we saw that bilateral loans did not do as well as the second quarter, finishing with a quarter-over-quarter growth rate of 0.84%. The quarter-over-quarter growth rate for participation balances was also not as strong, up just 0.19%. At the end of the fourth quarter, we see that bilateral loans did better than last quarter, finishing with a quarter-over-quarter growth rate of 1.39%, and participation balances rebounded sharply, up 4.2%. Looking at the year-to-date growth rates, we see that both bilateral loans and participations are up as of December. Bilateral loans have increased 3.3%, and participations are up 7.5%, for a combined rate of 4.5%, which is well above the pace reported last year. When we segment the growth by various loan sizes, the bottom left chart shows that bilateral balances were lower across the loan size segments less than $5 million in size, while the larger loan size segments and CRE increased during 2018. For participations, the chart on the right presents a different story. Here, balances have increased across every loan size segment and CRE, especially the 13.32% increase for the greater than $25 million segment, which jumped 10% higher in the fourth quarter. Boston, New York, Atlanta, and Dallas posted higher balances in this segment. The CRE segment is illustrated in greater detail on slide 8. Here we see that the quarter-over-quarter balance growth for CRE bilateral loans, which is depicted by the blue time series in the top chart, are up a modest 0.6%, which is half the increase we saw last quarter, while CRE participation balances were down from the prior period with a quarter-over-quarter rate of negative 0.9%. From a year-to-date standpoint, the growth rate for bilateral loans surpassed the growth rate for participations, with bilateral loans increasing 3.8% during the year, while participation balances increased at a rate of 2.8%. Moving to the bottom left chart, we segment the CRE activity for bilateral loans by loan size and see that only the smallest loan size segment, less than $1 million in size, reported a negative growth rate, while the greater than $25 million loan size segment is up more than 15%. The chart on the right shows year-to-date growth for CRE participations. Here we can see that significant growth took place in the two bookend loan size segments, up almost 13% and over 8% respectively. Balances decreased during 2018 for the other two loan size segments. The decrease in the $1 to $5 million segment can be attributed to lower balances in Los Angeles and San Francisco, and the decrease in the $5 to $25 million segment was seen primarily in New York and Detroit, as well as Dallas and Houston. Moving to slide 9, we look at balance growth trends a little differently. Here, the balance growth is measured using the year-over-year growth rates for each month. So in addition to the quarter-over-quarter changes that we saw in the preceding slides, this chart provides a way to quickly see how balances are trending on an annual basis. This chart also allows us to better account for seasonal activity. The chart on the left presents the aggregate loan trend, and the chart on the right breaks out bilateral and participations. As you can see, the growth trend for total loans was trending upward until May 2015, and then experienced a significant decline until July 2017. In recent months, the trend has held steady and most recently trended up. The year-over-year growth rate for December is 4.5%, which surpassed the 2.9% rate we saw for September in our last webcast. Moving to the chart on the right, we can see that participations were responsible for the steep decline, even going into negative territory from March 17 through March 18, while bilateral loan growth remained fairly consistent. December's year-over-year rate for bilateral loans is 3.3%, and with participations continuing to trend up over the most recent months, the year-over-year rate for participations is 7.5%. Next, we will leverage our pricing dashboard's drill down capabilities to pinpoint specific geographic and industry drivers of balance growth. We start with a look at the state profile. You can think of this as the regional winners and losers. The top 5 states and bottom 5 states are reported. It is important to mention that the geographic data presented in this webcast is based on the location of the borrower, not necessarily the location of the bank booking the loan. The chart at the top of slide 10 presents a state view for all loan types and reports the balance growth experienced in 2018. These charts are based on the change in outstanding dollars to determine the top 5 and bottom 5 states, and then presented ranked by the percentage change. New York reported the largest growth in total balances during 2018, up 7.7%. Higher balances in finance and insurance's securities and commodity contract subsector, as well as the traveler accommodation subsector within the accommodation and food services sector, contributed to this growth. We also see Florida up 7.5%. Retail trades, motor vehicle and parts dealer subsector, and the finance and insurance subsector of credit intermediation and related activities, as well as healthcare's nursing and residential care facility subsector, were responsible for the higher balances in Florida. In the bottom left chart, there is a breakout for bilateral loans. New York, Florida, and New Jersey all had balances increase more than twice the national average. The bilateral balance growth for New York of almost 8% was also concentrated in the finance and insurance sector and the accommodation and food services sector. We see Florida and New Jersey both up more than 7%, and these 2 states had significant increases in the finance and insurance sector during 2018. We will dive deeper into the loan growth we saw within the finance and insurance sector in our special topic segment of today's webcast. For participations, we see Massachusetts, Texas, and California with increases of more than 10%. All 3 states saw large increases in the finance and insurance sector. Massachusetts also reported significant growth in the telecommunications and chemical manufacturing subsectors. In Texas, as you might expect, the oil and gas extraction subsector and the pipeline transportation subsector were also responsible for the increase of more than 11%. While the computer and electronic product manufacturing subsector contributed to the participation growth in California. Using the AFS Pricing Dashboard, you can also examine trends within states. Our dashboard is configured to drill down beyond the state level and view trends for specific core-based statistical areas, or CBSAs. For example, we just saw New York in the top 5 states for both bilateral and participation loan growth. On slide 11, we can see that the year-to-date growth rate for bilateral loans in New York exceeded the national average of 3.3%, and the New York CBSA contributed to that higher-than-average growth rate. Buffalo and Rochester also posted positive growth in 2018. However, the growth experienced in the other CBSAs, Albany and Syracuse, actually lost ground during the year. This geographic precision allows us to distinguish the winners and losers very quickly and is the type of data you can leverage to be very competitive in your own markets. On the next 2 slides, we adjust our lens and look not only at the top 5 and bottom 5 states, but the entire country. On slide 12, the colors of the map indicate the level of dollar balance growth experienced by a particular state, with dark green indicating the highest level of growth and red representing a decline. So you can think of this view as a balance growth heat map for the balance growth across the country. The map on this slide focuses on bilateral loans, and we can see that balances were down across several states at the end of December. However, states such as New York, California, and Florida experienced significant growth in bilateral balances, as indicated by the green shading. All three of these states saw significant gains in the finance and insurance sector during 2018. Even though total bilateral balances are up for the year, we can see that balances actually decreased in a little less than half of the states, especially in the western Midwest, in states like Montana and North and South Dakota, Nebraska, Kansas, Iowa, and Missouri. The map presented on slide 13 changes our focus to the balance growth for participations. Participation balances were up in 2018 across most states. California, Texas, and New York are the top-ranked states, all with higher balances in the finance and insurance sector. Higher balances were seen in the computer and electronic product manufacturing subsector in California, in the oil and gas extraction subsector in Texas, and in the chemical manufacturing and manufacturing of petroleum and coal products in New York. As the last few slides have demonstrated, there are clearly a handful of geographic markets that have generated balance growth well above the national average. On slide 14, we present a more concise picture of this dynamic. Here, we identify and aggregate the top 10 CBSAs based on their contribution to total U.S. real GDP. The hypothesis is a region's level of economic activity is proportional to its potential for future loan growth. The top 10 CBSAs are illustrated in aggregate by the dark blue bars, whereas the lighter shaded bars represent all other geographic markets. Since March 2016, the pace of total balance growth for the top 10 CBSAs has accelerated during every quarter, far outpacing the growth rate for all other geographic regions. You can see on the far right that while total loan balances for the top 10 CBSAs continued to grow throughout 2018, climbing higher by almost 3% in the fourth quarter to 15.6%, the remaining markets have been treading water, hovering around 2.5% to 3% up through the third quarter. We did see balances in the other regions increase substantially in the fourth quarter, up 5.2%, but that is still much lower than the 15.6% fourth quarter rate for the top 10 CBSAs. The implication here is that while business borrowing may be picking up, the top 10 CBSAs have continued to experience significant increases in total loan balances, and the pricing dashboard has the data to help you find where opportunities exist in today's improving markets. As we move to slide 15, we continue our focus on balance growth and highlight the best and worst performing industries. The mining, oil, and gas sector is ranked highest for total balance growth in 2018, with the largest growth seen in Oklahoma City and Houston, as well as Denver and Dallas. Moving to the bottom two charts, in addition to finance and insurance, manufacturing and machinery and electronic products ranks among one of the top 5 fastest growing industries for both bilateral loans and participations, up 7.5% for bilateral and up 9.4% for participations. Wholesale trade is another industry with significant growth this year for both loan types. The chart on the left shows that bilateral loan growth and finance and insurance is the top industry, especially in cities like New York and San Francisco. Honing in on participation growth, we see that in addition to mining, oil and gas, and finance and insurance, the wholesale trade sector is also a top performer in the participation space, with growth seen in Atlanta and Los Angeles. A few slides ago, we saw the granularity that the AFS Pricing Dashboard provides users when looking at trends across the country, with insight down at the CBSA level. Our pricing dashboard also lets you examine trends within industries. The industry trends can be analyzed all the way down to the 6-digit NAICS code. On slide 16, we see that within wholesale trade, merchant wholesalers of durable goods had a positive impact on loan growth. Drilling further down to the 6-digit NAICS level, there are two subsectors that were responsible for the growth seen this year, most notably metal service centers and other metal merchant wholesalers, which was up more than 25%. Having this granularity is what the AFS Pricing Dashboard provides, and something for you to consider when you need very detailed data to support your own pricing decisions. In addition to examining trends in total balances, the AFS Pricing Dashboard enables users to analyze trends for new and renewed loans in order to gain valuable insights into the impact of the most recent lending activity. On slide 17, we begin with a look at new and renewed bilateral loans. Starting on the left, we can see that December's new loan volume is slightly higher than last December, and renewal volume is also marginally higher. We saw higher new loan balances in the finance and insurance sector and in the manufacturing sector focused on machinery and electronic products. The finance and insurance sector also contributed to the higher renewal balances, along with mining, oil and gas, and the wholesale trade sectors. Moving to the chart on the right, we focus on the pricing of the most recent lending activity. The LIBOR equivalent spreads as of December for new loans are higher than December of last year, while spreads on renewed loans were unchanged. When compared to the previous month, the weighted average LIBOR equivalent spread for new loans went down 4 basis points to 202 basis points. For renewals, the average spread rose to 219 basis points, which was up 7 basis points from the previous month. For your reference, the 10-year Treasury rate is also provided. The 10-year Treasury at the end of December was 283 basis points, which was 17 basis points lower than the rate that was at the end of the third quarter. The drivers of volume and pricing dynamics are presented on slide 18. The chart on the left provides the state and industry distributions of new and renewed bilateral volume for the most recent 12-month period, or in this case, for all of 2018. On the right side of this slide, we present the weighted average LIBOR equivalent spreads for the same list of state and industry segments. This view allows you to quickly see the correlation between loan volume and spread pricing. Focusing on the top of this slide, we can see that California, New York, and Texas captured the highest volume in 2018. From a pricing perspective, loans in the mining, oil, and gas sector and the healthcare sector drove up the average spread in Texas to 247 basis points, while California and New York were closer to the national average of 209 basis points. Moving to the bottom left chart, we can see that finance and insurance outpaced the other industries in 2018. While balances for this sector grew at a high rate, spread pricing of 206 basis points was slightly below the all-industry average, as shown on the bottom right chart. Wholesale trade was also below the national average due to low spreads in Los Angeles and Minneapolis-St. Paul. Across the top 10 industries, manufacturing and machinery and electronic products has the lowest average spread at 188 181 basis points, which is mainly due to loan pricing in California, Connecticut, and Ohio. And the mining, oil, and gas sector had the highest average spread at 297 basis points, which can be attributed to high spreads in Texas, Oklahoma, and Colorado. Next, we will quickly look at the volume and pricing trends for participations. On slide 19, the chart on the left shows that total new and renewed volumes for December are up when compared to December of last year, with the utility sector having the largest increase in new volume and the mining, oil, and gas sector having the largest increase in renewal volume. The finance and insurance sector also had significant balance increases for both new and renewed loans in December. Looking at the chart on the right, when compared to the same period a year ago, the weighted average LIBOR equivalent spread for new loans in December is the same as last December at 193 basis points. When compared to the previous month, the weighted average LIBOR equivalent spread for new loans went up 4 basis points. The LIBOR equivalent spread for renewals as of December is 217 basis points, which was up 17 basis points from last December and 12 basis points higher than last month. Moving to slide 20, the chart on the top left shows that over the most recent 12-month period, or again for all of 2018, Texas, California, and New York captured the highest new and renewed participation volume. The top right chart shows the pricing characteristics of these states, and we can see that Texas posted an above-average LIBOR equivalent spread of 254 basis points, which can be attributed to the riskier loans in the mining, oil, and gas sector. In fact, the average spread in the mining, oil, and gas sector for the state of Texas was 295 basis points. For the second largest state, California, new and renewed loans booked in the finance and insurance sector and in the utility sector that is focused on electric power generation, transmission, and distribution. These two sectors had spreads of 153 basis points and 146 basis points, respectively. And they contributed to California's below-average spread of only 174 basis points. On the bottom left chart, we see finance and insurance and manufacturing of machinery and electronic products ranked as the largest sector for new and renewed participation volume. While volume is high in these sectors, their average spreads of 175 basis points and 158 basis points were well below the all-industry average, as shown by the bottom right chart. Low spreads in New York and Los Angeles contributed to finance and insurance's below-average spread, and the manufacturing of machinery and electronic product sector had low spreads in San Jose, Philadelphia, and Chicago. Next, we look at the final layer of our market review. Slide 21 focuses on commercial loan fee performance. The chart at the top of this slide shows that total fees as of December were slightly better than the levels reported in the same period a year ago. As we saw with loan volume and spread pricing, the AFS Pricing Dashboard enables users to examine the regional and industry drivers of fee performance. The chart on the bottom left shows that upfront fee performance was up slightly this year for all regions except the West. From an industry perspective, the bottom right chart shows the industries with the highest fee level were mining and utilities. We examined the fees paid during 2018 to these two sectors and saw numerous six-figure fee amounts being booked in these industries. Next, for our special topic section of the webcast, Jeremy Charlson will build on what we've seen earlier and dive deeper into the loan growth and pricing trends for the finance and insurance industry. Jeremy?
All right, thank you, Don. So the big story this year has been the pickup in commercial loan growth. When we had examined this growth by industry, we noticed that finance and insurance was a major growth driver for both bilateral loans and participations. Now, this industry has been on our radar for quite some time now. Finance consistently ranks as one of the largest concentrations of C&I loans for banks in the Pricing Dashboard database. And unlike, say, the oil and gas sector, lending to finance borrowers is not restricted to any one area of the country. So what we'd like to do today is drill a little bit deeper into this particular industry. So at the subsector level, what types of loans and borrowers make up this industry and are driving the loan growth? We'll also look at trends in recently new and renewed deals to see how the pricing and credit risk characteristics compare between finance loans and the overall C&I loan market. And finally, we'll derive a measure of volatility for this industry. Now, there are many different ways that you can measure volatility, but for our purposes, we'll examine whether problem loan levels in finance and insurance tend to fluctuate more severely than the average C&I industry during periods of economic stress. Earlier in the webcast, Don presented 2018 industry rankings for balance growth, which showed that finance and insurance was a leading growth sector both for the overall C&I market as well as when we looked at individual regions. On this slide, we present a trend perspective in order to better illustrate just how rapid the loan growth has been in this particular industry. For each month, we measure the increase in balances relative to the start of the year. So really these pictures are cumulative loan growth trends. And let's start here on the left-hand side of the page. Total balances for finance and insurance, which is the green series here, were up nearly 20% for the full year of 2018. That's more than 6 times the loan growth rate seen for all other industries over the same period. Specifically, you can see that finance really took off in the fourth quarter of 2018. The loan growth differential is even more pronounced between finance and the rest of the market when we focus just on bilateral loans, with that picture shown in the middle of this page. For bilateral loans, finance and insurance accounted for close to half of the net change in balances in 2018. For finance and insurance, growth in participations and syndications was more inconsistent during the last 12 months. It oscillated quite a bit month to month. That said, participation and syndication balances rose significantly in this sector during the fourth quarter. In fact, that increase was a major reason for why the overall C&I market showed a strong rebound in 4Q. So not only is there strong loan growth momentum in finance and insurance, in many ways this sector was the main loan growth driver of the market's recent rebound in balance growth. Now, one challenge analyzing the finance and insurance sector is that it's hard to figure out just what types of activity comprise this industry. On first blush, it's really not clear what borrowers fall into this industry or what types of business activities they engage in. So to provide a little more transparency into finance and insurance, we illustrate the subsector composition here. On the left, we illustrate the distribution of loan volume across the subsectors in this industry. We've chosen to highlight the top 3 in terms of outstanding balances. The largest of these 3 is a subsector called Other Investment Pools and Funds. So again, the name really doesn't reveal too much about what's in there. But when we dug into the obligor composition, what we found is that this subsector contains open-end investment funds, trust funds and agency accounts, and most notably, real estate investment trusts. I will note that REITs were recently moved to NAICS 53 real estate, but some banks still categorize REITs as finance loans. So some of the REITs are falling into that blue slice of the pie there. Generally speaking, a large amount of the lending in this subsector is fueled directly or indirectly by the real estate sector. The second largest subsector in finance and insurance is other financial investment activities. Again, a name that doesn't really give you too much insight into what it's made of. What we found is that there are 2 broad groups of obligors in this particular subsector. The first is firms that provide investment advice and portfolio management. While these borrowers are not necessarily securitizing or lending out funds to other groups of borrowers, their business model is inherently volatile since it's tied to the stock market. The second group is loan brokers. So these companies match funds between borrowers, sometimes subprime borrowers, and alternative lenders. And then finally, the red slice of the pie there is non-depository credit intermediation. That's another complex subsector, and it's actually one that the benchmarking banks have told us the regulators are really focused in on right now. Borrowers in non-depository credit intermediation include mortgage companies and factoring companies. Banks with exposure to this segment may be indirectly exposed to fluctuations in the mortgage market and other areas outside of the C&I lending space. This means that balance growth and loan defaults for this subsector are very sensitive to fluctuations in variables like the unemployment rate and U.S. mortgage rates, especially under an adverse economic scenario. All three of these subsectors realized positive balance growth in 2018. You can see that by the right-hand graphic on this slide. The only one that really didn't see a heck of a lot of growth was non-depository credit intermediation. That had about a 4% growth rate when you round it, but the other two clearly had tremendous balance growth over the last year. So the main takeaway from this slide is that finance and insurance borrowers often securitize and channel funds into other potential asset classes. So even when the intermediaries themselves have strong balance sheets, banks can create indirect exposures to these other asset classes when they lend to the intermediaries. Finance and insurance consistently ranks as one of the largest subsectors in the Pricing Dashboard database. We've seen this as a big exposure going back all the way to 2011. And that large exposure size is something that's reflected across most of the participating banks. So what we did here on this slide is we grouped the banks into quartiles based on the relative size of their finance and insurance exposures. The banks with the highest exposure to this industry are grouped in the top quartile. That's the red slice or the red bar there. And what that red bar says is that a quarter of the Pricing Dashboard banks have at least 11.7% of their total wholesale exposure concentrated just in finance and insurance. So 11% of all of their C&I and CRE loans have a finance and insurance NAICS code. For the median bank on this chart in blue, finance and insurance made up 7.4% of the total C&I and CRE balances. Note that even the bottom quartile bank in green displayed 5.5% of its exposure in this industry. So really across the board, all the banks show a meaningful level of exposure to finance and insurance. And as such, any changes in the growth, pricing, or risk characteristics of finance and insurance will have major consequences for all the bank's future performance. A fascinating aspect of this industry relates to its risk-return profile. The left chart on this slide plots trends in weighted average LIBOR equivalent spreads, with the picture restricted just to new and renewed loans in order to provide a more current and dynamic view into the loan pricing. As illustrated here, the average spread for finance and insurance, the green line, consistently trended beneath the average for all other industries. We should note, though, that the sector's credit risk outlook, as measured by weighted average risk rating, was consistently more favorable than the average for all other industries. You can see that comparison by the right-hand chart. So when comparing finance and insurance to the rest of the C&I loan market, the difference in credit risk is more pronounced than the difference in spread pricing. In other words, for finance and insurance, the favorable credit risk more than offsets the sector's relatively low spread pricing. The next slide here examines finance and insurance's risk-return profile in relation to other major industry groupings. And I think this slide is absolutely fascinating, especially when you look at the x-axis here, which is weighted average risk rating. On a relative basis, finance and insurance, which is the green circle on the far left, had the lowest or best weighted average risk rating of all the major industries pictured here. So it had lower credit risk or better credit risk than even the healthcare sector, which generally is the industry that we perceive to have the best credit risk. Banks are also realizing a very decent spread on finance and insurance loans. In terms of spread pricing, if you look down the y-axis there, finance and insurance was above or on par with several major industries, such as healthcare, manufacturing, retail trade, and real estate. So it has a decent spread and the best credit risk, the best weighted average risk rating of all of these major industry groupings. It's possible, though, that the risk ratings for finance and insurance might be a little too optimistic given how the revenue and cash flows of these companies may be dependent upon the underlying performance of many different intermediaries, which could span real estate markets, non-banking organizations, and even some types of leveraged lending. For the last several years, credit conditions have been relatively benign, so it's hard to know just how these loans would perform during a period of economic stress. The chart here depicts trends in non-accrual loans over the last 15 years for finance and insurance versus the C&I average. And what this chart tells us is that finance and insurance outperforms the C&I average for non-accruals during economic expansions, but performs significantly worse during periods of economic stress, such as the years following the Great Recession. So you can see around the 2010-2011 timeframe, finance had a much higher spike in non-accruals than we saw for the average C&I industry. Mathematically speaking, finance and insurance is 1.6 times more volatile in its non-accrual trend than the C&I loan market as a whole. We derive that number as the beta, or the slope between the market series and the line for finance and insurance. So what this suggests to us is that should economic conditions take a turn for the worse, as some economists are saying might happen as early as 2020, problem loans in the finance and insurance industry could begin to rise at a very rapid pace. So what have we learned about finance and insurance? First and foremost, the sector was a major catalyst for loan growth in 2018. In fact, in many ways, it was predominantly responsible for the rebound that we saw in the fourth quarter of this year. The sector's composition is very diverse. REITs, loan brokers, factoring companies, and mortgage companies all form a complex web of credit intermediation in this industry. The recent performance and credit risk outlook for finance and insurance remains favorable. Its weighted average risk rating for new and renewed loans remains beneath the C&I average, and as of the latest quarter, non-accruals were also very low in this sector. But it's important to note that if you look over a longer-term horizon, if you look from a historical perspective, finance and insurance does display a much higher degree of volatility in terms of non-accruals when compared to the typical C&I industry. So that concludes our look back at the year of 2018. It was certainly an interesting year and maybe even an encouraging year in terms of loan growth. Before we take time for questions, I do want to point your attention to some charts that we have in the appendix. We've included some economic statistics as well as some line utilization stats, so you'll have that for your reference when you receive a copy of the deck. And I think with that, we'll take some time for questions.
We would like to thank everyone for attending today, and as promised, we will send you a link so that you may listen and download the presentation. Thank you and have a good day.